He just posted a Truth Social. And I'm going to put this up on the screen here in just a moment. Where's my... Oh, there we are. Here we go. So this just posted moments ago to Truth Social from Trump. Whether it's true or not, I don't know. We're kind of getting to the point where it's like, how much this is psychological warfare? Is he pissing off the eye? I mean, there's so much behind the scenes. I have know nothing about. You know nothing about. I don't know. For whatever reason, he's claiming they're making good progress. Comes with the usual threats of keeping the Hormuz Strait open, and so far, the stock market is liking it. I guess we're kind of holding up here. We gapped down. We opened up down here last night. Stock market is up about 1.25% overnight. About 20 minutes into the market open, and if you look at the metals over here on the right, that's our kind of one of our good signs. Tin, aluminum, copper, thank God, platinum, palladium, silver, copper, all kind of, and gold, all kind of moving here. Let's see. Is it the May contract? Nope. Micro silver. Here we go. Tried to take a little breakout trade in silver here moments ago. We'll see how that one does. We had a little shallowing base here. Got a nice little push, kind of came in, started moving nicely, and then is reversing on us. We'll come back and check on that in a few moments. But overall, markets, we have a gap up this morning, but it has been an ugly, ugly couple of months. We, because of the situation in Iran, and mainly because of the spike in crude oil, stock market fell about 9%. So almost a correction territory. The technical levels, a 10% pullback is considered a correction, and a 20% drop peak to trough is technically a bear market. And if you look at the NASDAQ, I think it officially entered correction territory Friday afternoon. Right in there on the dip. So, not ideal conditions. I put out my weekly newsletter on Friday evening, as I do, kind of running through the things we look at in the market. And, some of our metrics are not ideal for short-term swing trades. And so while I don't think we are entering a massive bear market, it's not a 2022 or anything like that. I do believe conditions are poor, and we probably want to stick to more either shorter term in duration trades or just kind of going very light with what we're looking at. So anyway, I'm going to walk you through this. Whoops. Let me, if I can video capture. Now, if you notice a different background, I have finally moved back to my office. I've been working out of my house for the last 5 months because the internet conked out here and I had to wait for AT&T to come run fiber lines. But we are back, so let's go ahead and dive in. Now, how many people, out of curiosity, are here for the first time? Type me if you're joining for your first live stealth trade session. Just want to see how many people we have that are brand new, and if so, we'll kind of go to the basics and cover what our approach is, and then we'll dive in a little bit more detail and find some good opportunities here. But just if everyone's been here 4 or 5 times, we don't need to do that. But the Lego G-Wagon, it is at the house. I need to bring it back over here and put it on the shelf. It looks like a crash to me. I mean, yeah, it's violent, but when it's really not violent, but it's where we are is back at essentially August of last year's level. So we've lost the last 6 months of progress in the market, and we've really been just in a giant holding pattern for the last, call it 6 months here. It's really only the last, 30, 45 days where we've pulled back. Now, this was a crash. Okay, this, when you fall 20+% from the tariff situation, that was a crash. we're really just kind of in no man's land right now. So a lot of you guys here for the first time. Okay, welcome, welcome, welcome. All right, well, let me start at kind of the beginning, give you an idea of the foundation of what we're doing here, because I think this is really important to understand the big picture of the markets, how stocks work, and what you should be looking for. All right, so I like to show this, and we've shown it before. If you're new and never seen this, I highly encourage you to screenshot this or at least pay close attention. This is the 4 stages of the stock cycle. And every single stock, from Google to Apple to Amazon to Jim Bob's bait, tackle, and trampoline store, is going to follow the exact same 4 stages. And it will repeat these stages over and over and over throughout the life cycle of the stock. Now, this is a weekly chart of Roku. I can show this to you on Google or Amazon or Apple or PayPal or any other you want, but the 4 stages are the same. And the whole idea behind this is that it is not you and I that move stock prices. It is Goldman Sachs, it is Warren Buffett and Fidelity and Schwab and BlackRock and State Street, the big multi-billion-dollar shops. Because when they're buying a stock, they're not out here picking up 10 or 100 or 1,000 shares. They're buying millions and millions and millions of shares. And when they do that, it moves the prices. It also takes them a while to build positions. Warren Buffett famously spent 2.5 months building his position in Apple, and that's one of the most liquid stocks on earth. And so our job and what these stages do is show us where the stock is in this cycle, because we want stocks in coming out of stage 1 or in healthy stage 2 uptrends, all right? So stage 1 is the accumulation phase. Now, this one's a bit skewed because what was happening here in March of 2020, yeah, this was COVID, right? Everything sold off. So without it, it would have been more like that. But stage 1, typically stocks going nowhere in a hurry. It's just bouncing around. It's like watching paint dry. You'll hear it referred to as a value stock or it's cheap, whatever it may be, but it's nothing exciting. This is when institutions begin accumulating that position, because a lot of what they do is essentially a giant Excel spreadsheet. They're typically not trading on technicals like you and I are. They're trading on fundamentals because, again, it takes them 3-4 weeks to buy up a stock. It takes them a couple of weeks to get out of it. They can't day trade. They can't just pop in and out with stop losses. They're trying to invest from a fundamental standpoint. And so, they might be using a discount cash flow model. They might be trying to project whatever they're doing. They're going, all right, well, the company has this much in cash, this much in assets. They're making this much in profits. We think they're going to grow 15, 20% for the next 3 years and then 10% and et cetera. And we think interest rates are going to be here and blah, 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 blah. And it spits out a value of what that stock is worth today. And they think it'll be worth 2-3 years from now. So in the case of Roku, it's over here in stage 1, trading at, $100, $120 a share. Their model might say it's worth 400, so they start buying it up. Now, eventually, the stock pushes out of stage 1 and is into stage 2. It's the markup phase. And this is where all the magic happens, all right? This is where all your money is going to be made, at least 95% of it. And in the markup phase, there's consistent demand for this stock. It is running into new highs. It's got good technical momentum. Typically, it's got good sales and earnings growth. It might be a hot new product, a hot new service. It could just be in the right place at the right time. For example, the last few years, anything with AI attached to it has been in stage 2. But for whatever the reason, the trade is on, the stock is hot, Wall Street wants it, retail wants it, and that consistent buying pressure, day after day, week after week, runs the stock higher, and it usually moves pretty smooth. The 2 lines you see on that chart, the red is the 50-day simple moving average, and the white is the 200-day simple moving average. And what you'll notice in stage 2 is it very rarely goes below the 50-day. In fact, this one never did, just rolled right up alongside it, because anytime the stock falls 5 or 8 or 10 or 12%, and you're one of Warren Buffett's traders saying we need 200 million shares, you're going to just buy more and buy more. You're going to take advantage. And so that support is what allows the stock to run without ever having any big dips. But eventually the party comes to an end like all do. Maybe the stock has reached or exceeded the value they thought it's worth. Maybe the growth in sales and earnings slows down. Maybe the product fell apart. Maybe the story changed and Trump started bombing Iran and it changes. Whatever the reason, the party's over and they won out. And institutions tend to dump it a lot faster than they buy it up. Because when they want out, they just want out. They want to be first. They want to dump it. And you'll see stage 3 begin. Typically, it'll be the largest drop since stage 2 began. And if you look here at the chart, notice we never went below this red 50-day moving average. Then it closed on it. Then it closed below it and then stayed below it for several weeks. It's over. This stock fell 33% in 2 weeks. Okay? And the only way a stock loses a third of its value is in 2 weeks is if big, massive institutions are dumping lots and lots of shares. And stage 3 is where the average investor gets in trouble. This is where they go, oh, look, a dip. I'm going to buy the dip. And in this case, it worked for a couple of weeks before quitting working. Sometimes it'll come down and just do this and then roll over. But stage 3 is not an opportunity. It's the beginning of the end. Because when you and I and our neighbors and friends are buying up this stock in the dip, we're not buying every day for 2 months straight. We don't have billions of dollars to deploy. We're putting $1,000, $10,000, $100,000 in the stock and we're done. And so once that consistent buying pressure is gone, once the daily support is no longer there, it becomes a game of uncle. And then it's my stop losses here. There's a ton of stop losses here. There's some in here. And this is when the diamond hands proud guys get just absolutely massacred and the stock rolls over into stage 4, known as the markdown phase. And on average, a leading stock, I'm talking an Apple, an Amazon, a PayPal, in a stage 4 will fall 50 to 80%. And if you don't believe me, come back to this video in 2 years. You will see a 50% drop in NVIDIA. I almost guarantee it. And then it just repeats. It's now cheap again. It's back into stage 1. Some value investors come in, and then it's going to bounce around the lows until the company starts turning around. Earnings are ramping back up. A new CEO comes, whatever it may be. But this process will repeat over and over and over again for pretty much the life of this stock. And even if you look at the big guys, like a PayPal or something, take that to a weekly chart. I mean, look at this. This thing was soaring at $300 a share 4 years ago. There we go, fell 80%. It just kind of stayed down here. If you look at a company like Crocs, CROX, this is the IPO. This is the initial public offering. See the big stage 1? See the clean stage 2? See how it pretty much held this, I'll give it a little bit below right here, but for the most part, held this 50-day moving average. I'll make this candle. Some of you guys prefer candles. And then look at this week right here. Wham! 31% down in a week. It's over. Period. Hard stop. I don't need to revisit. I don't need to see what the news is. There is no way in hell anything good comes after a 31% drop in a week. And look at how short this stage 3 was. It came down, and look, it held for 1, 2, 3, 4, 5, 6 weeks. What was going on in here? Why did the stock suddenly stop falling and stay there for 5 or 6 weeks in that circle I've drawn? Who can tell me? Just use common sense. What happens after a stock that went from 10 to 80, falls back to 40? What does everybody do? They're buying the dip, right? Thank God, a dip I can finally buy. And so all that buying of people who had FOMO for the last 6 months are piling in. They're supporting the stock. All those new buyers are absorbing the shares being dumped by the institutions. But once we're done buying, there's no institutional buying that's going to continue pushing this thing higher like it was in stage 2. And it just goes, it completes at stage 4. And this one fell from $80 to $8. In fact, I think it went all the way to 1. And, you'll see this over and over again. Look at it over in here. Same thing with 2020. Again, this was the COVID dip, so kind of ignore that sell-off there. But look at how clean a stage 2 was. Just beautifully holding the 50 days. It rallied from $40 to 150. And then up, now we're down below the 50. See, it's getting all wiggly and it's whipping back and forth. The volatility's there that hasn't been there any of stage 2. That's the beginning of the end, goes into stage 4, back into stage 1, repeats the process all over again, okay? So these are the 4 stages of the stock cycle. The reason I like to share this is we just want to see, where are we in this cycle? Where do we stand? Let's look at Apple, for example. You know, this was a stage 4. I think we're in stage 3 in Apple. Where is NVIDIA? To me, it's been in stage 3 for almost a year now. It's just, you know, it gets legs, it pulls back 20%, it's up, it can't get any traction, it's breaking below the 200. I could be wrong. I've been wrong again. I've been wrong before, but I think you'll see NVIDIA probably back down around here, which is going to be about a 50% drop sometime by the end of the year. So we know our goal is to find stocks that are either entering stage 2 or already in stage 2. And once they are, where do we want to buy? Well, our go-to pattern is a breakout pattern that will take place when a stock is in stage 2. And I'll show you an example here in SMR, okay? Let me just go back in time. I want to show you this one because this is actually a trade we took with our members. All right, so this is what we're looking for, something like this. And I'm going to turn the moving averages off because for our illustration, it doesn't matter. Now, a stock in stage 2, right? The markup phase, the trend is behind you, the buying is there, it's what we want. How do we identify a good buy point? Well, what I like to do is try to exploit the laws of supply and demand. And it is important to think about stocks in terms of supply and demand. Demand is, I would like to buy some. I have a demand for that stock. Supply is, I would like to sell some. I've got some. It is supply I will offer to the market. And anytime demand exceeds supply, if more people are trying to buy something than sell it, the price is going to go up and vice versa, right? Just universal Econ 101. It's the same in a housing market, the used car market, the Beanie Baby market, the rare coin market, you name it. And it's no different in the stock market. So how do we find those points where demand is much higher than supply, where a lot of people are trying to buy it and there's just not very much available? Well, that's where this pattern is going to come in, okay? So the first thing you're going to see, this is a bit of an extreme example, but you're going to see a big rise in the stock. Now, that's just our signal that there's big demand. That's a 360% move in 3.5 weeks. That's monstrous, okay? 20 or 30% is plenty, but big move up. Now, let me actually go back a little further. When a stock quadruples in 3 weeks, what do a lot of people decide to do? Well, they decide to sell, right? And trust me, if my stock quadruples in 3 weeks, I'm going to be one of them. I'm selling. I'm happy to take the money. And there's a lot of that. The stock just goes too far, too fast, and that profit taking drives it down. Now, if this stock is in fact in demand, if those institutions that cause the stage 2s that are buying the stock day after day, week after week, month after month, they are going to respond and take advantage and drive it up. Now, at this point, they pushed it from 4 to 7. Some people who saw it go to 10 and all the way back down are going, oh man, I almost had a monstrous amount of money. It came all the way back down its back. I'm going to take some, taking my second chance. They're going to sell it. Again, institutions or big players are going to drive it back up, take advantage of that dip because they're trying to accumulate a big position. It'll come back here and hit 6 or 7 for the third time. There's a little selling. They drive it up, selling up. But what's going to happen is it is going to form this kind of shallowing pattern on the chart. And this one's not quite like textbook, absolutely perfect, but you see that same idea. See how it comes in here and shallows and tightens and absorbs. See that? And what's happening here is that supply we're talking about is being sucked out of the market, okay? Think about this in real dollar terms. This is a stock. Pretend it's a widget in your pocket, whatever. And I don't care if there's 1 million shares, 1 billion, or 1,000. There's not infinite. and they're not all for sale, right? Every share of a stock is not currently sitting there with a for sale sign on it. You have some in your 401k. They're sitting in exchange traded funds, in mutual funds, and endowment funds. Whatever stock Buffett owns, he's going to hold it for 20 freaking years. So the only available shares is what's known as the float. How many shares are currently out there being offered for sale? And so what's happening in here is they buy it up and buy it up and buy it up and buy it up, is they're absorbing that supply. Anyone who got scared out of the stock from the dip, anyone who got shaken out from the swings, anyone who read the analyst downgrade or saw some article and on a Reddit board about what is going down, whatever the reason, they're just gobbling up all the stock they can. Until eventually they've bought all the $5 and $6 and $7 stock that's available. No one else will sell it to them. They've shaken and scared and bored everybody out they can. And so that's why these dips get shallower. And if we look at what's happening here, this was a huge one. That was a 67% drop. This was a 37% drop. This was a 14% drop. This was an 11, 12% drop. They're getting shallower because there's fewer and fewer shares available to buy. The supply is shrinking. And so now these big guys that are buying and buying and buying and buying, once there's no more people they can shake out or scare out or convince them to sell this stock at $5 or $6 or $7, if they want more now, they got to pay up. All right? No one else will sell for, would you take 7 or 8 or 9 or 10? That's what allows the stock to run very far, very quickly. And this is why we want to buy right there as it's breaking out. And you'll notice here it breaks out, from call it $6, $7. One little retest, look at all that support, bounces right back in, and it goes from 7 to 17 in a month. Okay? So if we can find these stocks in stage 2, in good markets, coming out of a clean breakout pattern where supply has been absorbed, where demand is very high, we can risk 10, 15% to potentially make 50 or 100, in this case 130, we'll do pretty well. We're not going to win them all. It's never been done. You're not going to be the first. I sure as hell don't win them all. But even if you can get them half right, if you make 40 or 50% when you're right and you lose 8 or 10 when you're wrong, you're going to make a mountain of money. Now, the tough thing today, March 30th, is conditions are not great. I know that swing trades I placed today in the middle of a war with Iran, with skyrocketing crude prices, with above average inflation, I know my win rate is going to be lower. I don't like it, but it is what it is. 7 months ago, we were getting 60, 70, 80% of these things right. Now we'd probably be getting 20, 30, 40% right because the trend is not going in your favor. The overall pressure is downward. And so that's part of it. Your decisions at this point are, all right, go really short term, day trade really light, doesn't hurt if you're wrong, or just kind of step back and say, I'm going to be super picky. I may normally take 3, 4, 5 trades a week. I'm going to look for just one if I see it. Okay? This is true, Delia. Index trading, free of all those issues. Well, you're just riding the market. I mean, you mean like actively trading the index or just owning? If you're about just indexing, yeah, sure. You don't have any of those issues. You just enjoy your 9% a year. And if you're content with that, and you got a 10, 20-year time frame, sure, absolutely. Index it. I mean, I've got, my kids' college funds are just indexed because I'm not being super active with it. But if you're trying to say that like it's a random walk on Wall Street and nobody beats the market, you could not be more wrong. I mean, there are people who've consistently, explain the guys who generated 40, 50% compound annual growth rates for 20, 30 years straight. explain Stanley Druckenmiller, who's had a 32% compounded return for the last 3 decades. You can't, right? So there is a way to outperform, but it's monitoring that risk reward, finding some kind of an edge and really rolling that over and compounding it. Let me see what silver's doing here. Nope, tagged us out of the silver. Okay, so I was trying to do a little silver trade this morning. If you look at the silver futures, it wasn't really perfect, but it's pretty close. See how we got the big run up overnight, and then it started to come in and shallow and tighten here, and kind of, it wasn't perfect, but I tried to get a little push out here. It's kind of rolled over a little bit on us. Let me see what we can find in the crude oil market. That doesn't look too great either. Now, this pattern I'm showing you here, it works in stocks, it works in crypto, it works, I sound like a salesman, it works on everything. It takes out stains, fixes your floor. No, but when you're just exploiting supply and demand, it's going to work on any freely traded market. In fact, it's going to work better on crypto and commodities because there's no earnings surprises. There's no CEOs diddling a secretary. There's nothing. And if you look at crude here, this is the middle of last night. I unfortunately was sleeping when this setup came. But look at this move here. So see how it had the big shock, big supply dump with whatever happened. This is last week. This is Thursday. But see how it came in and see how it tightened up and absorbed that supply? And then look at how it came outside and then just released that energy. And this is a 5-minute chart. You can do this on a daily chart, on a weekly chart, on an hourly chart, a monthly chart. In fact, let me show you one of the best setups I ever got our members into, and that was gold. Now, the big breakout in gold, I'm just going to go back in time here, okay? And you need to see this because this will change your entire perspective. The initial breakout in gold took place in March of 2024. And let me just go to like a daily chart here. And you can kind of see it here. Again, it's not going to be perfect like to the penny. This is the stock market, things come in. But you just want to look at that big picture. So on the daily chart, you had November, December, January run up, big coming in, tightening. See how it's shallowing, tightening up in here, and breaks out around $2,100 an ounce. Okay, nice little clean move there. Again, we're going back 2 years, but I tell you this because in the weekly newsletter 2 years ago, it said my whole article is about the beginning of a gold super cycle. So it's not like hindsight trading. I mean, ask our member, we put them in front of this. Now, let's step back to a weekly chart. Each one of these candles is now a week. Well, you had the big run up in 2019 and 2020, followed by a 3-year base as this came in and shallowed and consolidated and tightened. And so, again, on a different time frame, on a weekly chart, we had this exact same pattern setting up for a breakout here at around 2,100. And then this one, we can even go out to a monthly chart. And we're here looking at the last 2 decades. And what do you see? A very similar pattern where we had that massive run in the early 2000s where gold went from 300 an ounce to 2,000. It then, for the next 10 years, consolidates, tightens, shallows, and breaks out again at 2,100. So daily, weekly, monthly, all lining up. Every time frame, everything's saying we're breaking out. That's why I put out that article. And that's why in our weekly newsletter, I said I believe we're at the beginning of a super cycle in gold. Let me see if I even have that. There it is. Yeah, this is that newsletter. See that April 2024? I don't know if you can even see that up there. Anyway, but this is the email we sent. I'm sorry, I said in April, not March. April of 24. But that was the breakout, right? And so, we fast forward to today. This is how that's played out, right? So it was a monumental move. We go, oh, Ross, gold is crashing. And I do a YouTube channel. I get videos every time. Oh, you've been on the wrong side of gold. No, I assure you, I've been very much on the right side of gold. And so have a lot of our viewers here because of using this fairly simple technique, right? So again, conditions today, they could be better, right? I don't love where we are, but I am patiently waiting for opportunities here. And when the conditions are better, we'll go heavy. So here you can see this in gold. Now that pattern I showed you from back here in 24, multiple times it has offered you new buy points. Now again, remember what I said, the 50-day moving average, how it kind of supports it in stage 2. Notice how it has done that until now. So that's a bit worrisome on the downside. But look at how many times we've seen this pattern. So it made that big surge, comes in, shallows, tightens, breaks out, big run, once again, shallowing, tightening, breaking out, surge, tightening, shallowing, breaking out, short one here, shallowing, tightening, breaking out. And I thought we were setting up for another. We came in, we were looking pretty good, thought we'd get another push, and then Trump said, I'm going to start dropping some bombs. And that kind of threw a wrench in everything, right? And, that's just part of the game, unfortunately. You get the most perfect pattern in the most perfect market with the best conditions, and then COVID happens, or massive rate hikes, or war with Iran, or, whatever it's going to be next. Who knows? We're going to learn that we're all inside of a simulation or something. Strong performers didn't stop losses during the last couple of weeks of correction. Would you consider re-entering near that support? Yeah, I would. So yeah, this is a great example, AU, right? And ideally, this same pattern I'm showing you here, I'd like to see the same thing off the lows. So I want to see that same idea of absorbing supply. And if it does that, that's going to be a really great entry to get in on the return higher. And that SMR stock I showed you before. So this was that buy we did over here in 24. Well, we bought it again in May of 25. And hold on. So this stock, which had surged, right? We bought it over in here, went from 13 to 33. Then the tariffs come, and the thing gets absolutely massacred. But then look what we got here off the lows. We got that exact same pattern forming as we're coming lower and lower and lower, and then it starts to tighten and consolidate and firm up. Notice the volume was kind of decreasing in here, little spikes on the upside. It breaks out, nice big clean up volume day. We bought it right here at, I want to say $17 or $18 a share, and it just went to the moon from 17 to 37 in 2 weeks. So I'm not saying we sold right here at the tippy top, but you buy here, you're at 50%, you sell some, you're at 100%, you sell some. The thing trails, you get out your final piece here, you netted 60, 70% on this stock in 3 weeks. That'll cover a lot of 8 and 10% losses, right? So there is a link in the chat. I should have mentioned this. If you are not already a member of our Black Ops service, click that link. You can just go to tradewithross.com. It is $5 for the entire year. And we do these live sessions twice per week. The Thursday one is members only over Zoom. You'll also get my weekly newsletter. You'll also get access to my staff. And then we also give you this market health indicator, which you can add to your trading view, which is going to show you where the strength in the market lies. Now, right now, there's not a lot of strength. And I know you came here thinking Ross is going to show me the 2 stocks going to surge today. We might find them, but I'm just being totally honest with you. Conditions are not great. I think we all know that. And there's nothing wrong with saying, I don't have a big edge right now. I don't want to risk my money. I'll wait till next week. I'll wait till this thing blows over. But in a good market, which we have been in for the bulk of the last 3.5 years, this is going to tell you where the strength is. Because those breakout patterns, and the thing driving the stocks, the big institutions, typically invest in given areas. Like I said, they have to invest from a macro point of view, a fundamental thesis. They're not going, oh, this stock's forming an ascending wedge pattern to buy. No, they're going, all right, we believe strongly nuclear is going to make advances this year. It's going to power AI. There's new tech. Its regulatory environment's good. So we're going to buy all the nuclear stocks. In 22 and 23, they were going, this AI thing is going to be huge. They're going to sell billions of chips. We're going heavy into the semiconductors and NVIDIA and Intel, et cetera. Back after COVID, it was work from home. This thing is changing the world. Our lives are different. We're going to buy Zoom, where we can have meetings online. We're going to buy Teladoc, that benefits from people having telehealth appointments. We're going to buy Peloton, because nobody wants to go to the gym and try to breathe through a surgical mask. That was the theme of the market. And so whatever they are buying, the strongest areas are going to rise more than the others. And if we can focus on those leading areas, on the groups and the sectors and the industries that are driving the market higher, we have a stocked pond to fish from. And that, all things being equal, is where you have the biggest edge. And for the last, I'd call it year, the theme has been pretty clear to me, and we've talked about this 100 times, but that theme is metals and energy. And what we're seeing is a lot of fear in the market. The AI bubble has become fragile. Is it real? Yes. Are they spending trillions? Absolutely. Is it going to change all of our lives? You betcha. But so did the internet, and that led to a bubble in the late 90s. And what happens is these stocks get too expensive based on what they're actually making. They price in perfection until they roll over. But the bottleneck for this whole thing, for these thousands of AI data centers, is power and materials. The grid can't handle it all. It's going to be some kind of alternative energy or natural gas or nuclear. They're using massive amounts of steel and copper and other materials. And so, and the precious metals is surging because inflation's high and the whole world wants out of the US dollar. They're going $39 trillion in debt and counting. I give up. I thought Trump and Elon might have a chance of slowing those spendthrifts down, but it doesn't. Republican, Democrat, young, old, doesn't matter. They all spend like drunken sailors. And so they're getting out of the dollar. And so what are the best performing areas been? Well, gold miners, for one, has been a top performing area. The energy sector, solar energy, broad-based energy, solar energy, energy, nat gas, energy, nat gas, energy, nat gas, solar energy, right? Very, very clear theme of the energy. And this is over 1 and 2 and 3 and 6 and 9 and 12 months. Rare earths have been very strong. We've seen the government take positions in some of these stocks. We've seen war with China, not technically war, but economic war with China over them. And that's your rare earth magnets, that's lithium, that's all things going into this. And so these are the areas we've been most focused on. And some of the stocks, in fact, the bulk of the stocks we've bought have been in these areas. If you look at, let me see if I can show you this. So this is Next Power. And this is, by the way, this is our Alpha Stock service. It's a premium service we run here for our members. It's obviously more than $5. We do all the work. We text them the alerts. We have live sessions. We track it all for them. Somebody's done really, really well. But the last several have been In-Phase Energy, NXT, which is energy, Solana. That one didn't actually work out. Silver, gold, those kind of stocks. And we're buying them for this exact same pattern. And if you look at NXT, see that shallowing? See the stop loss? So we got in this thing risking, 10%? And it went up 60 in 45 days. It's a great risk reward. It then comes in. Again, shallowing, tightening up right in here. Breaks out, beautiful move. It pulls back with the Iran situation. Stops right at that breakout area. Perfect retest and bounces again. And so if you have the discipline to be picky, to be disciplined, to take a stock and over the last year, there was 3 points you could buy it. And not, I'm just piling in. Oh, I just want it. Oh, I see it going up. No, 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 no. Like actual patience and having the sit out power to go, I'm going to wait for a perfect setup like over in here. Once it starts ripping, I'm not going to get FOMO. I'm going to wait for another setup. Once it starts surging, I'm not going to buy unless it dips to here or if it sets up in a new breakout pattern. And if you did that, if you can be disciplined, you can do very well. In phase is pretty choppy. One of our gold miners, what's the big gold mine he's talking about into? Open a list and see. Oh, Ken Ross. All right, I bought this one. I'm trying to play a little bounce in here. But look at Ken Ross Gold. Now, we've been long this stock from, when do we buy this thing? Over in here, I think, on the breakout. But look at some of the clean buy points. Gold has been in a clear uptrend. It has been a leading sector for the last all of 2025, bulk of 26. And when you see these clean breakout patterns, that's when you want to pounce. I bought over in here. You can see it did very well. It's come back. It's rolled over. I think I took, what did I take? Bought at 30. I think I sold half and I was up 20%, something like that. But now I'm down $58 in the final 100 shares. It's not a big deal. But that's been a leading theme. So that's kind of the shopping list, right? I'm going, all right, where are the leading areas? Well, if it's gold and metals and rare earths and energy and nat gas, I'm going to look at the top 10, 15 stocks in each of those, and that's the only place I'm going to shop from. George, if you want me to fire off a bunch of trades right now, and I hope you're going to be okay, out $5. If I need to refund that to you, I'm happy to do so. I can feed you trades in a terrible environment, and you can take losses and tell me how bad I am on the internet, or I can try to tell you when you have an edge or not. It's up to you. Thank you, Matt, who's still up 78% on KGC. What about CEG? Constellation Energy? I mean, to me, I don't think it's ready. Had a big sell-off from 360 to 250. It couldn't get above its 200-day moving average. It's trending lower. Wouldn't be my pick. Kodak. Let's see. Film company. What is going on with Kodak? Not one I'd want to chase. The stocks have been extended. It's up 50% in the last month. I don't know why or what's going on with this. Kodak, adios, advanced freeform battery technology. Kodak's been a bit of a meme stock the last 5 years or so. I mean, they started pivoting to generic drugs back in 2020. All kinds of different stuff. Well, yeah, see how choppy it is? See how it's, up 50, down 50, up here. It's not a clean tradable stock. Compare that to something like a KGC. See how a nice, clean, trending stock that is? Riding the 50, clean breakouts, shallow retracements, nice. That's what you're looking for. And if you're trading a stock like a Kodak, that's just extremely whippy. The only way I would trade this is very, very short term. This little 5-minute chart in here. Okay, I've got a bit of a support shelf or a resistance shelf. I had a big push up here. I've kind of got a shallowing base. Okay, I might buy it in here at 8, but a stop at 8.5. Take a $50,000, $80,000 position. See if I can get a little bit of profit from it. Sure. Is Ion Q at the bottom of its trough? I don't know. I mean, you can see the setups in here that I've marked in Ion Q. So we had kind of a lower cheat entry in here. The big, breakout pattern is over here. And some are going to say, well, Ross, it's down from there. Listen, if you buy a stock at 48 and it goes to 83, if you get up 73% in a month and you let that turn into a loss, we need to have a whole different conversation. I am not trying to find stocks to hold for 6 months or 6 years. Swing trading using daily chart. The daily chart is designed to predict the next 2 to 8 weeks. The weekly chart designed to predict the next 2 to 8 weeks, 2 to 8 months, right? So this is what I'm trying to target. I'm looking for stock in old 2, 3, 4, maybe 6 weeks. That's it. And if I get up 70% in a month, I'm happy. I'm trailing a stop. I'm out at 69. But IonQ now, what's it doing? Well, number one is staying below this dash 50-day moving average, which is the exact opposite of what I want. In a stage 2 uptrend, the stock should be, for the most part, holding above that 50-day moving average. Once it gets below it, and now it stays below it and cannot get above it, that's a very clear downtrend. In addition to that, I'm just seeing, now I drew a line over in here because what I was hoping was this stock, which was beginning to shallow, would come up and tighten and break out. But it didn't. And I didn't buy it because it did not break out. You're not risking anything if you're waiting until the breakout. And instead it went lower. And now it's making lower lows, lower highs, lower lows. So everything about this stock from a technical standpoint says do not buy. But all we're doing is reading the chart. We're letting the buying and selling do the talking. AA with the 5-minute jump up. Okay, Alcoa trying. I don't know what just happened, but wait, that's a daily chart. Hold on, sorry. Okay, so we got a little gap up in Alcoa, a big gap up, 11%. Yeah, I mean, I want to see, stocks that gap, either gap and run or what I call gap and crap. So you want to let the first 15 to 30 minutes trade out. If it's the start of something new, it's going to break to new highs, at which point you could risk a couple bucks and try it. If not, and it breaks to low of the day, you don't want any piece of this thing. Is lithium breaking out? Let's see. Is it LIT? Yeah. Yeah, it's trying. This is when it becomes very tough because markets and stocks and industries and commodities don't operate in a bubble. What changed about gold in the last 6 weeks? What changed about the value of Google stock? Is, Advanced Auto Parts making or losing any different amount of money than they were 6 weeks? No, nothing has changed. Then why is everything down? Because we're dropping bombs, we're entering a war, there's a lot of uncertainty, and that changes everything. And these big shops, the BlackRock's holding $9 trillion in assets, go, okay, our model says reduce risk by 5% when a geopolitical event happens. Cool. That means they're dumping $500 billion worth of assets across the board. Gold, stocks, ETFs, commodities, you name it. I don't think we realize the size of this stuff. So many dollars are just broad-based indexed, passively managed, that when we have these macro events, excuse me, it just crushes everything. And it is not fair, but it's what happens. And so you're kind of swimming against the tide if you're just forcing money in when everything about the market is telling you this is not your time. You want to buy Micron long. Where do you enter? Okay, if I wanted to own Micron long, I mean, if it'll come down at 240 is going to be your best spot. This one is a little bit tougher to me because I'm like, well, it's not, it's, again, just selling off everything. Now, it was actually getting some strength into this, which is interesting. So this must be earnings related. Isn't that funny? You can beat earnings and sales by 20 and 30% and the stock still falls. That's what I was talking about. Everything's based on a model. Doesn't matter what stupid analysts think. The guys would listen, if analysts were so great, they'd be trading stocks. They're not. If economists knew at any idea what was going to happen, they'd be trading stocks. I've never met a rich economist. Okay. The market is pricing stocks based on their expectations of sales, earning, interest rates, and everything going forward. The other tailwind on this is that we've gone from expecting multiple rate cuts in 2026 to we might see a rate hike. And all of that has happened in the last 3 weeks. And rate hikes are bad for stocks. When interest rates go up, money markets pay more, bonds pay more, government paper pays more. And money is incentivized to go out and get a 5% CD instead of risking it in the market. And when you can get a 4 or 5 or 6% fixed yield, well, then if I'm going to buy stocks, I need a much higher earnings yield. That stock price needs to come down to make it more attractive. That's all that caused the 2022 bear market. The Federal Reserve raised rates 500 basis points. We went from 3% mortgages, maybe 400 basis points. We went from 3% mortgages to 8% mortgages. Money markets at the bank were paying you 1%, suddenly they're paying you 5.25%. That's very attractive. All that money comes out of stocks. And so when rates go down, when bonds and money markets and CDs are paying less and less and less and less, they're going, well, hell, I'm just going to go to the stock market. I'm only getting 2% on this bond. I'll buy this company at 40, 50 times earnings. At least I get the growth. And so that's the correlation between rates and stocks. And so when we're spending billions overseas on someone else's war, when we're causing oil to go from $65 a barrel to $100 a barrel, that's going to make inflation worse. That's going to pass down to the consumer, to the business, everyone in between. And for the kind of middle income, when your gas bill doubles, that really hurts. For the lower income, that decimates you. For businesses, your UPS, your FedEx, anyone who ships anything, your costs go up. Airlines, massacred. Look at Delta. From 77 to 55, right? And that just changes the whole picture because suddenly inflation was a little high, now it's going to get real high. Rates were going to probably get cut, now they might get raised. Debt was really bad, now it's really, really bad, right? So I'm not saying we're entering like this massive multi-year bear market, but we had a tailwind, and then suddenly here at the end of February, everything changed and conditions deteriorated very, very quickly. Lots of questions on BORR. Okay, BORR is an insider pick. Everything I've talked about today has nothing to do with insiders. The strategy I'm teaching is primarily technical based, right? We're looking for institutional buying and selling. Now, BORR we bought because insiders were buying the stock. And I'll show you this. You can see they're insider buying. Now, it is a totally different strategy. They both work. There's nothing wrong with either one. I played lots of money on both. But teaching it how to follow insiders takes a lot longer than an hour. But what we saw was this big insider buy-in here. $1.3 million, another from this guy for $2.6 million. Now you look at the stock, it almost never sees insider buying. In fact, if we go back 3 years, there's been no insider buying until this month. $3.9 million worth. And so we see these trades. We have people with, he's a first-time buyer. This guy, yeah, both first-time buyers. And so, energy is hot. Oil prices are rising. Two of the top insiders at Board Drilling are buying. The stock's up 25% in the last 4 days. We're following along. Got a big, huge uptrend. In the last 10 months, the stock was quadrupled. Now, from a technical standpoint, where would be my ideal buy point on BORR? Well, ideally, when I look back at this chart, my ideal buy point would have been right here. Okay, so when both these line up, and you got insider buying technicals, it's a monster. But look at this, from 2 to 4, look at it comes in. See the shallowing, see the tightening in there, breaks out, shoots from 4.5 to 6, and then look at this. When it pulls back from the war, right there to a retest, bouncing higher. And look at how quickly it goes up. Remember, what drives prices is institutions, the big guys. And what we want to see, all things being equal, is big response to dips, right? When it falls from 6 to 4.5, we don't want to see them kind of sticking their toe in the water. I'm going to pick up a couple shares. We're going to see. I want them going buy, 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 buy. And this thing, which pulls back for a month, returns in 5 days. So it's very, very strong tennis ball type action. So BOR looks very good. I mean, we look at the market health. The only area showing any strength whatsoever is energy and energy and energy, right? That's leading. We have an energy stock with insider buying, with a good uptrend, with massive stage 2 buying. So, yeah, I like BOR, BORR. Oh, thank you, Scott. DXYZ is matching the averages. Is that normal? So Destiny Tech is a volatile little sucker. What this is an ETF, an exchange-traded fund. Excuse me. But instead of holding stocks, it holds equity in private companies. So most ETFs, for example, SOXX, is the semiconductor ETF. It holds NVIDIA, Intel, AMD, all the big semiconductor ones, right? Publicly traded stocks. It's Galaxy, sorry. What was the ticker? I'm forgetting, losing my mind. Destiny, thank you. Destiny, on the other hand, holds private companies. And I'll show you what they hold. So it has a stake. Let me blow this up so you can see it. Whoops. There we go. SpaceX, Shield AI, Databricks, xAI, which is Musk's company, Revolt, OpenAI, Sam Altman's, Kraken, Monzo, Redwood, Vastspace, Axiom, Stripe. None of these are publicly traded companies. None of them have stock symbols. And typically, the only way to buy a private company is to invest in a seed round, generally only open to venture capital or people with more commas in their accounts than I have, right? Nobody calls me when they're doing a $20 billion seed round for SpaceX AI because they won't take my 50 or 100 grand. Their minimum's 10 million, 20 million, 50 million. So what they do is go, all right, we're going to raise a bunch of money. We're going to go to the table. We're going to buy a stake in SpaceX. We're going to get in on the xAI, Series F round. We're going to get in on OpenAI. And so you can buy this publicly traded stock that has exposure to all these private companies. It's a really interesting ETF. Here's the tough thing about it. We have no idea what in the F this thing is worth, right? SpaceX doesn't trade every day. Stripe doesn't trade every day. I can tell you exactly the value of any public company up to the second. I have no idea, right? SpaceX did a funding round at $600 billion. A year later, it's at 1.8 billion or 1.5 trillion, excuse me, some crazy number. So this thing moves pretty volatile because everyone's just kind of guessing what those stakes are. What SpaceX can IPO at? Is it anywhere near an IPO? What are their current valuations based on the latest funding round? Is it technically 30, 40% higher? Because I heard they're going to do a Series J with a higher, it's a crapshoot. And this thing, just like back when SpaceX launched their Starlink satellites, people realized, I want a piece of SpaceX. How do I get it? Well, this is one of the few ETFs that had it. And look at that. I mean, it went massively overvalued. But it quadrupled in a month until people stepped in and go, that's crazy. It's not worth that. And, it's been massively corrected since. So this is very much a trader's stock. It's not anything being accumulated by institutions. Institutions have access to the private markets, they want it. But look at this. I mean, this thing went up 35% in 24 hours. It then falls 15% on the day. It's down 20% in the last 3-4 days. I mean, it's just very, very volatile. Now, as a day trade, yeah, I'd be all over this. In fact, this one was setting up to something that could have looked good, but it went the other way. Yeah, it went down this morning. But the Friday setup after falling had come in, kind of consolidated, tightened up. If it had broken out here, that would have been a pretty good little day trade. Risk 80 cents a share, try to make $2-3 a share. But that's the only way I would play a stock like Destiny, unless it just got massively cheap and I did the math and said, all right, based on what I believe, their SpaceX stock is worth, $20 billion or, whatever the number is, right? Which is below the market cap, and I do a value plate on it. Will you buy a short-term call in any energy stocks? Yeah, I mean, on a good setup, I would. And they're really the only group that you're going to look. I mean, some of these are extended. Like here's Exxon. So I guess we're about a week late on Exxon, but you can see, I mean, this thing just huge run, and then it kind of came in and tight. I want to see some kind of consolidation, right? And maybe they keep going, maybe they don't. That part doesn't really matter. What matters is that I can get a good risk reward. And the problem is, so I mean, just like the Destiny, for example, if you buy this stock, you go, oh, it's going up, I want to buy it. Well, yeah, it's up like 75% in 3 weeks. You are very much at risk of a violent pullback in here when you're buying extended stocks. However, if you're buying stocks that are coming out of consolidation, when, they've made that run, and then it spent a couple of weeks absorbing that supply, tightening up, you just have a better chance of getting an acceleration. You could buy Conoco right here. It very well made it go 145, 155, 165. There's nothing about this stock looks bad right now. I just prefer to buy it coming out of a consolidation versus the top, because when it's running, you don't know when it's about to start a consolidation, right? And if it does that and you're underwater for 3-4 weeks straight, it's just not a position I want to be in. EOG Resources, Schlumberger, it's kind of a midstream. Marathon is just rocking. Phillips is rocking. But can you see the difference? Even if the pattern is not perfect, even if you just go, all right, well, let me just wait till I get some kind of consolidation in there, some little absorption of supply, your odds are massively better when buying coming out of tightness into expansion. All right, think about a stock like a spring. It's either coiling up or it's releasing that energy. But buying them at the top after that big release, you really run the risk of getting into this. And if you bought this thing, February 26th, you've been in it for a month. You were down. I mean, you weren't never down or a lot of money, but like there's better places to be with your money, right? Versus over here, see how it is, consolidated and tightened and compressed and releasing that energy. That is when I prefer to buy. And I hate doing these live sessions when it's not that point. Sometimes it is. Gold, I'm hoping, is absorbing that supply down in here. And it had that one little downtick that went beyond this. That one little day where it shot down to 4,000, but it came all the way back and closed at 44. But look at how you had this perfect consolidation breakout. It surges, gets evaporated in 2 days with the margin raises, stops right there at the breakout area. Bounces again, rolls all the way, and now it's again trying to stop here. So if it breaks down and rolls over, yeah, we're probably going to like 33, 3,400 right down in here. If not, if it will consolidate, if the buyers will step in, if it will finish absorbing this supply from the sell-off and kind of just sort of come in here like that over the next couple of weeks, then I'll be buying again. And we're probably going to 5,200 and beyond. But we're just reading the market. We're just letting it do the talking without indicators, without any any tools other than our eyeballs. XOVR portfolio is almost 45% of SpaceX. I mean, I'd have to know how many shares it has and what the valuation is of those, because the market clearly doesn't think it's overvalued. So this is this is a mutual fund, not a holding company. 1.8% expense ratio. Good night. Places a cap on AUM for the fund. That's when reached, the fund will trade more like. Oh, it does close the fund. Okay. Budget monitor AUM levels. All right. So what I want is always, all right, what's this thing worth? Well, okay, if it's worth $465 million, if they have $500 million worth of SpaceX, absolutely. Right? Absolutely. Yeah. If they have $50 million worth of SpaceX, well, that doesn't give me much of a cushion, does it? So I don't know the answer to that, but that's what I'd want to know. When SpaceX goes public, does Destiny get out of it? That's a good question. Probably so. I'm guessing since their goal is private. I'm sure you have to read the laws in the or how they've drafted that thing. Let's see if AI will do it. Okay, it says it's not set up to automatically sell into IPO. It does not have a strict policy to sell immediately on IPO. It acts as a long-term holding vehicle. So yeah, they may hold it. I don't know. Be interesting to find out, because I'd want out as soon as that thing IPOs personally. I did the Venezuelan play and CFP, CVX are up 500% on average. Thank you, Mike. Get some heat in here this morning. I appreciate you, brother. Good job. The coal ETF. Let's see. What is the coal ETF? I forget. Oh, yeah, it's coal. Ah, it looks great. Yeah. Yeah, coal's really a sleeper. I think it's very viable in here. Yeah, I think it looks great. And this is a great example to use. And I know I kind of come in here and I like Monday morning quarterback and going, should have bought here, should have bought here, should have bought here. But I just want you to see this stuff. When you give me these examples, I want you to see how many great opportunities there were. Now look at coal here. So was it trending higher in 24 early 25? No, it's getting absolutely massacred. I don't want anything going down that fast. Excuse me. But then eventually, big pop, shallows up, tightens up, clear resistance, clear as day. $18 is where the sellers are. When it breaks out from 18, you buy, it goes to 22. Comes in. Now, it really had like an entry here as well as an entry here. Either one did very well. It comes back, sells off, tightens up again, breaks out from here. And you could even kind of make a case, it's not pretty, but you can kind of make a case for pushing out through here as well. So yeah, if this same approach, waiting for supply absorption, waiting for supply and demand dynamics being in your favor, is going to help you time the buys off the lows. It's going to help you time the buys breaking out to new highs. It's going to prevent you from buying extended stocks with a high percentage of a big pullback. And overall, it's going to lower your risk-reward ratio. And if you will take that a step further to focusing on the leading areas of the market, everything's kind of getting hammered right now, but some stuff, energy is obviously still very strong. You'd focus there. I lost my camera. There we go. Energy is still very strong. You'd focus there. When the market comes back, when we get some kind of resolution with Iran, you'll see everything come back ripping once again. And we'll see the clear strength. I believe it's still going to be metals, industrial metals, precious metals, as well as energy. But focus on those leading areas. And listen, here's the reason we've been doing trading today. The net new highs for the overall market One, two, three, four, five, six, seven, eight. The last 9 days in a row, more stocks have made new 52-week lows and 52-week highs. For the first time since June of 2025, less than half of stocks in NASDAQ are above their 200-day moving average. The NFCI liquidity measure, showing how loose or tight the financial markets are, has been drastically tightening for the last 30 days. The advanced decline line. Oh, by the way, they have a big Easter sale at TradingView. If y'all are, usually, I guess they added Easter. They used to only do this for Black Friday. So if you want to get your annual, good time to do it. The advanced decline line is stopped making highs and is pulling back. Interest rates, specifically the 10-year yield, is up 60 basis points in a month. Again, I'm not predicting a massive bear market, but it's very obvious the odds are not in our favor. So instead of forcing stuff, instead of entering trades in an environment where we have a probably 30% chance of making money, except maybe the energy space, why not just take a beat, perfect your craft, learn what to look for when the timing looks good, and then when it comes, strike very heavy. Trust me, when conditions are good, I tell everybody, you'll see me placing $50,000, $100,000 trades here live with you. I promise. I'm going to do it right here with you. And if you see great opportunities, please take them. But I just feel like I have a responsibility not to be willy-nilly placing trades people are going to follow when conditions are kind of poor. All right? If the coal ETF is good, why wouldn't I take it myself? Well, I think the trend looks very good. It's not something I'd want to buy. I don't love the setup enough to buy it at current prices. I think it looks very good. Again, I want to be very picky in this environment. Right over here, yes. Even maybe over here. Come on. Maybe over in here as we came in. And we're kind of see how we kind of came in and tightened. Maybe right in here. But I just want to be really picky. And if this thing is 7% above my ideal entry point, and I've got to put a stop loss to swing low, which is about 9%, it just seems a little rich. I want really, really good setups right now. The market is just too ugly. Over in here, okay, I buy it. I'm risking 5%. Yeah, I'll do that. Over here, I'm buying the breakout, and I'm risking 4.8. Yeah, this is a bit extended to me. It looks great. It looks like it's going higher. I wish I owned it. But I'm being very, very, very picky in an environment like we are now. I mean, even if you want to take this little swing in here and go, all right, well, I mean, at most, absolute tippy top, I want to pay for this is kind of right in here at about 27.60. So if it dips to 27.60, I might take a stab. That way I can risk 6-7%. Otherwise, it's just, again, just being picky. That's all. Givo just broke out. Yep, sure did. Yeah, I don't know much about this stock. I'm guessing it's pretty small, 650 million. Yes, we got a small cap here. Yeah, pretty easy to spot the resistance in there, though, right? Now, this thing is pretty wild. You really had what they call kind of a cup with handle pattern in here, where it just sort of came in and, tightened up. Yeah, even this one, I'd want to be in from 255. But pretty good volume. I mean, it's already done half the average daily volume, and we're only an hour into the market. So, yeah, probably worth looking into. Yeah, I kind of think you're right, Big Farm. I think when this thing settles out, energy. I mean, look, it's very real possible we see $200 crude oil, but here's how I can't predict that without knowing what Iran's going to do. It is very much possible we see $200 crude, and if Iran does not calm down, if they keep firing, RPGs or whatever the heck they're shooting off the side of camels at the oil tankers going through the Strait, this thing flares up. Yeah, I mean, look, if you cut off all the oil over in the Arab states, whatever they cannot go through pipelines puts onto a tanker and goes into the Red Sea through the Hormuz Strait. And if they can't get it out, and their tanks are full for storage, and the pipelines are maxed out, you're going to have less supply, and that's going to drive prices higher, especially physical crude, right? So again, maybe they back down. Maybe they say, F you, Trump, we're doing this, we're blowing up. I don't know what's going to happen. I'm not a military strategist. I don't know foreign policy. I don't know. I don't like the boots on the ground. I don't want a single American over there on soil risking our lives for these animals. I don't want any of it. But no one asked me. I'm not in charge, and I don't know how they're going to react. I'm not smart enough to know. So if you know the Iranian military regime pretty well, you know the 31 military provinces and how the command works, and you believe firmly they're not going to back down, it's going to escalate, I'd be long crude. I'd keep buying energy stocks. If you think they're pretty much eviscerated and that's going to be over in the next week, I'd be shorting energy. I just don't know. Yeah, Star the Industries, exactly. All right, guys, we're about half an hour over time. I'm going to go ahead and end the stream here. If you haven't already, go to tradewithross.com or click that link to get signed up for our Black Ops service. It's $5 for the entire year. These sessions every Monday, another with my top analyst every Thursday, access to our industry strength indicator, my weekly newsletter, which goes out every single Friday evening, as well as some bonus reports and more. So click that link, get signed up. It is just $5 entire year. And if I can't give you $5 in value, I will refund you myself. All right. Thank you all for joining. Any questions, let us know in the comments. I'll be glad to try to come back and answer those. But otherwise, we'll see you next week.